Hi, everyone. Thanks for joining us. I'm Emmanuel Rios, Philanthropic Advisor,
I'm Kelly Mardica, Associate Director of Gift Planning.
and we're so grateful for you to join us today. We've got a wonderful presentation. We'll be doing another on-demand investor briefing today. We've got some really great presentations from Mike, as well as a kind of curated question list that we've received from our various donors and philanthropic partners related to our investments. We'll have Mike's presentation followed by a Q&A and then a quick wrap up. And without further ado, I'll turn it over to Mike.
Thank you, Emmanuel. It's a real pleasure to be here today to provide some information regarding the Greater Milwaukee Foundation's investment results, investment strategy, and what we see happening in the world's capital markets and economy today. It's a very interesting time in history, as is always the case. So we turn to the next slide, Claudia. Here you get a look at the returns of the portfolio compared to a variety of benchmarks. As a reminder, the blue bars reflect the Greater Milwaukee Foundation corporate pool's investment returns net of investment management fees. The gray bars represent our long-term benchmark, which is to preserve the purchasing power of the assets entrusted to the foundation in perpetuity. And so this is a really important measure. It's actually the main reason that we do any of the work we do here. The red bar reflects a very simple mix of 70% global stocks, 30% bonds. It's ultimately the market benchmark we're trying to achieve, because the CPI plus spending benchmark, those gray bars, is not a market-driven benchmark per se. And then the green bar is a portfolio that mimics the foundation's strategic asset mix over time. So it uses a variety of common index funds to reflect each part of the portfolio. A little later, I'll be showing you the portfolio's asset mix, and there you'll be able to see kind of how that benchmark is constructed a little bit better. So the first thing to point out is, if you look at the calendar year-to-date period, there's a couple of things that are worth mentioning here. So first of all, the portfolio is up a little over 8.5% year-to-date through June. It's actually up more, and as we sit here in early August recording this, it's closer to 11% now, which is nice. But nevertheless, the fact is, at the end of June, this is where we were sitting at about 8.5%. And what you can see is a couple things. One is, just as a point of interest, most people coming into 2023 were not expecting a good market, and we've had a very good market, in fact, which is really interesting and a great testament to one part of our strategy, which is not to try to predict the markets in the short term. We have no idea what they'll do, and that's quite liberating at times like this. I'm glad, because we would never have any idea. Now, the other thing you see, though, is that both the red bar and the green bar are a little bit ahead of us this year, which is an unusual occurrence. And it's happening mainly because something I'll talk about a little bit later, which is that the markets have been dominated by just a very small number of very popular big companies in the United States. And we do under-own those companies to some degree, mainly because we think there are lots of other opportunities, and we don't want to concentrate in just a few names, because that is quite risky. Now, as you go across the page, you see a couple of things. The picture does start to change. First of all, the gray bar, which is the CPI plus spending, has, generally speaking, been a tough benchmark to beat for a very long time, particularly in the last 3 years. And that's because we've seen rising inflation. Now, you see year to date, not quite as big a deal. And that's exactly what we thought would happen, which is that inflation would eventually start to come down. An interesting question, of course, for all of us will be whether we'll ever go back to the levels we saw prior to COVID. Our guess is it'll take a long time for us to get there. But the other thing you see, particularly to go out to the longer periods, 20 years and 10 years, you can see the portfolio, and even 7 years, outperforming the benchmarks, but really, really hanging tough with the CPI plus spending. So let's go to the next slide for a moment. And it's really interesting when you change our perspective. So on the slide you saw a minute ago, all the bars are similar in height, which kind of makes them all seem similar in importance. But the fact is that the long-term outcomes are vastly more important, mainly because they're long-term, and because we have the opportunity to take the numbers you saw before and multiply them by a number of years. That's ultimately what we do with long-term results. So the small gains of 2023, which is the left side of this graph, don't look so large, don't look very big at all, as you can tell, compared to what's happened over 10 or particularly 20 years. And the reason for this is these are cumulative returns. So they are actually, believe it or not, the exact same returns you saw on the prior slide, with one major difference. We're now compounding them out and not referring to them as we did in the other slide in a per year basis. So this gives you a very interesting picture. And I think the part of it that probably, I know, is most important, in fact, not probably, is the 20-year graph. So again, this is exactly what we would have hoped to see happen. So essentially, the red 70-30 index was outperformed by, or was out, the green bar outperforms the red bar, which is good, which means that the strategic mix that the foundation has employed over time, again, using index funds, did better than a simple 70% stocks, 30% bonds, which is about the same level of risk as our portfolio, just to be clear. But then you see the blue bar again, which is actually significantly outperformed the green bar, and of course, the red bar by extension. And that's the value of the active management that's been added to the equation. This is net of investment management fees. So this is after everyone's gotten paid on the fee side of investment management, and we have a significant premium. And what's really interesting when you think about it and exciting is that premium was what we needed to achieve our goal, which is to preserve the purchasing power of these assets over this 20-year period. It's a very, very hard thing to have done that. That spread you see there is extremely important in terms of the mission of the foundation and all of you and those who preceded us and those in the future, I hope too. But it's also just really important that we achieve that goal even when the odds are against us, which leads us to the next slide, which shows us a little bit about how to think about performance compared to other endowments and foundations. So that if you look at the line in green, we have the community foundations return. So these are the numbers that we didn't actually show you on the very first slide. So the per year numbers, not the cumulative ones you saw on the prior slide, but these are the per year numbers for the foundation. Underneath that is something called Invest Metrics E&F median return. And in English, what that means is it's basically about 900 endowments and foundations around the country. And this is the middle of the distribution. So median is middle, half did better, half did worse. And the way to think about this is really to look at the gray bar above, which is which group of 25 percentiles or quartiles did we end up in? First is the best. It means you're in the top 25%. We don't actually strive to be in the top 25%. We like to be, don't get me wrong. We actually strive to achieve our goals, which are not related to the horse race of competition here, but instead are related to preserving purchasing power, as I talked about a minute ago. So very important that we think about this as just basically an after effect, a sideshow of what we're doing. But we like to be in the top, and we actually do realize that more often than not, you end up if you actually achieve your goals, you do end up in the top. That's the way to think about it. So first is top 25%. Second is you're above the median, but you're not in the top 25%. Third, which you don't see on this slide, I know we'll talk about it anyway, means you're below the median, but you're not at the very bottom, which is fourth quartile. Now, over the years, and you can see this here a little bit today, we've been in the second quartile, we've been in the third quartile for short periods, and even once or twice in the fourth quartiles for short periods. And we like to use the old hockey analogy that one of the reasons that we can suffer a little bit in the short term is we're doing things that are different than the markets, and we're doing things that are different than other investors sometimes. And the goal is not to be with the cool crowd at every moment, but to be what the next thing the cool crowd will want to do first, to get there before them. And so that's something that we think about a lot. And so we're willing to take on some short-term disappointment in exchange for long-term excellence. And this isn't really qualified for disappointment, if you ask us. We're outperforming the average endowment foundation in the second quartile, as you can see. You can even see if you look at 3 years, for example, we're not in the top 25%, but we were just below it because 8.1% is a significant premium to the average endowment foundation per year. But more importantly, if you get to 7 years, 10 years, and then I come back to 20 years in a second, we're back in the top quartile. That's where we've been for many, many years. That's where we want to stay. That's what drives and motivates the Crucial, the foundation, the investment committee, the board, and we're all on the same page on this, obviously. And then last but not least, if you look at the 20-year number, there's a little asterisk there, which refers to the fact that it's not even top 25%, it's top 10%. And if you thought about that prior slide, that outperformance that got us to basically match CPI plus 5 demanded that we outperform, I believe, 94%, of the endowments and foundations in the country to do that. So that was the kind of headwind we faced. It was not easy to do it, but we've had a lot of success. And I think the strategy we employ hopefully gives us very, very good chance of continued success. So we turn to the next slide. Let's talk about the strategy that's used. Very important to remember that no matter how much people who have good investment outcomes would like to be considered smart geniuses, pick your word, the reality is that's not how it works. The best investors, the people who do what we're trying to do, which is to deliver consistent outcomes over very long periods of time, not short periods of time, have to have a simple playbook, which does not demand that we be geniuses. Instead, it demands that we have beliefs that we can adhere to, and that we apply them consistently, and that we don't fall away from them when things get a little disappointing in the short term. So that kind of conviction and confidence are really important. And our strategy is very simple. And those who have seen these videos before or been with me before in the room, you know the strategy by heart, but it's simple. And let me just explain it. 3 points. Point one, we think long-term. Extremely important. Every decision we make is based on what do we think will happen 5, 10, 15, 20 years from now. And therefore, the reason we do that is because we can use history as a guide. It's an extremely valuable guide, even if the world's always changing. The world's always been changing. Second point, we do not predict the short term. So the opposite of thinking long term is thinking short term. And the vast majority of, frankly, of what all of us are subjected to is very short term, whether it be on television, things we read, I guess today, podcasts, whatever it is, everyone's making short term predictions. And the reality is they're playing lottery tickets. And we don't play lottery tickets with the foundation's assets and your assets that are entrusted here. So when the investment committee meets, you might be surprised to hear, but nobody tries to figure out where the S&P will be at the end of the year. No one guesses whether the Fed will make have another interest rate increase. Nobody talks about whether we'll have a recession or not. It's not because these things don't matter, but because we don't know anything about them that other people don't know. And so there's no advantage. Hence, there's no source of really great returns that comes from that. And then last but not least, we have to be diversified. The beauty of having a very large, hundreds and hundreds of millions of dollars of assets to invest is that we can be very diversified. And we take that very, very seriously. It's the best way to achieve balance between short-term and long-term outcomes. We go to the next slide. This will give you a look at the strategic mix of the portfolio right now. So I mentioned earlier that we have a benchmark that's custom benchmark, and it uses this slide essentially as its basis. So for example, I'll explain the numbers in a minute, but you can see US large cap equity or US large companies are 13% of our target, which means that S&P 500 is 13% of the index. By contrast, you can see, you can jump down the page a little bit, US aggregate bonds are 6% of our target. That means the Bloomberg, or it used to be called the Lehman aggregate, but now it's the Bloomberg aggregate, is 6% of our index. And there's indexes assigned to each one of these pieces. So what you see here is the mix that the investment committee and by extension the board have adopted, which consists of 62% in stocks, 12% in fixed income, and 26% in alternative asset classes, including the foundation's mission investments. And what's really, really amazing about this is how well it's worked over time, how much it's kept us in control of volatility in times that were difficult and allowed us to be really consistent as we push through with this strategy. A couple quick things to point out about it. The committee reviews this once a year. They don't change it every year, to be clear. So very important. And when we do change it, it tends to be very subtle. We're not making big changes because, again, we don't have short-term insights. We have long-term insights, and they don't tend to change that much over time, although obviously when market conditions change, our long-term insights can change. But with that said, you can also see that this is a very long-term oriented portfolio. Achieving CPI plus spend rate requires that you generate a lot of return. And that means you can't put too much money in assets that allow us to sleep better at night. So the bond exposure is small, and it's small because we know it can't generate the 7, 8, 9% returns we need to succeed long-term. But the other thing you can see here is how much diversification there is in this portfolio. It's really important. And again, it would have been a lot easier and this year more successful, in fact, just to put all the money in a few US large companies. But that's a very risky strategy, and we cannot tolerate, nor should anyone tolerate that risk. And then last but not least, we keep this portfolio as close as we can to these targets. There are pieces of it that are a little outside of our control, like the private assets and the way those are valued, but everything else is generally kept very close to these targets. And thanks to the generosity, of the community, of your community, we have lots of cash flow that we can use to make that happen. So we'll go to the next slide. And let's talk about the success the foundation's had in terms of its active management. A lot of investors today have, and for very good reason, headed into index funds in a heavy way and have sort of abandoned ship on the active management side of things. And I understand why. It's a very hard thing to do right. In fact, it demands really two things. One is access and understanding of who the great managers are out there. And frankly, I will tell you, in all my years at Crucial, very rarely has someone sent me an ad or us an ad and they were a great manager. It's the ones we have to go out and find them ourselves because they don't market. So when you read about somebody, they're advertisers, it doesn't mean they're bad, but the greats generally don't do that. And so it's really takes that good sourcing and underwriting process of Crucial, which we've had a lot of success at. But perhaps even more important is an investment committee that is extremely disciplined, knowledgeable, and patient. Patience is something that is a very hard skill for people, especially, there's a lot of pressure on everybody, which is we want to deliver for you, which means in the short term, when we're not delivering, we feel the pressure and sometimes you want to do something about it. But the ultimate answer is if you've done your work correctly in the first place, you just need to wait. So the three things that if you were Crucial, you'd be taught is one, that we need to have a high bar for all of our managers. We're not interested in managers who can outperform an index by a small amount. I'd rather just own the index. We need to basically generate big premiums, in one, because we want to outperform, and two, because we will make mistakes. And when you have your mistakes can cost you a little, and when you get big premiums from your winners, the balance is right, and you get a good long-term outcome. So that's why we're very focused on a high bar. The second thing is the people that invest your money, the foundation's money, must have an edge. It can't, and the edge cannot be, I'm just smarter than everybody else. That is not an edge. You can't also even be harder working than everybody else. That's not good enough. You need to have something else. It might be your specialization, it might be your time horizon, it might be your EQ. A lot of people do have trouble with the EQ, or the emotional quotient around investing, because it is emotional for people. And we really work hard to understand whether people can handle stress. It's a people business at the end of the day. And I can't emphasize that enough. And the last thing is, there are risks that are not worth taking. Leverage is one, a weird one for many of you, excessive risk aversion. But what that means essentially is when people trade off good nights of sleep for lower returns. And we're not doing that here. And we don't want anybody else that does it either. We need people who are pressing for the returns they get, doing it smartly, doing it with a lot of incredible discipline, but they can't be fearful of something bad happening. That's not a good way to manage money. So we'll jump ahead, another slide. And here you will see something that is integral. I mentioned something a second ago, which I can't emphasize enough, which is this is about people. Yes, I know there's a lot of computers managing money these days, and a lot of people rely on computers to tell them what to do, but really not the people who manage the foundation's money. We're looking for individuals who bring tremendous grit, tremendous talent, and tremendous differentiation. And so the key point here, and there's two words that I probably should highlight and underline the next time, but they're our favorite words. We learned from a great manager, by the way, and variant perception. And what variant perception in English means is that we are looking for people who see something different that the rest of us don't see. And that's a variant perception. And there's nothing more powerful as investors than to have both a variant perception of something different, and you have to be right, of course. It can't just be different. And so what people miss when they don't have appropriate diversity in their portfolios is how much diversity, gender, ethnicity, age, location, how these all tie into our worldview and how we approach things. So the same set of facts looks different to me than it might look to you. And part of that is our upbringing. Part of it is where we live. Part of it is all these other factors. And so diversity is, yes, it's about having a more equitable society. Yes, the asset management industry is woefully in need of this, but it's more importantly, even more important, I don't know if it's more important, it's very importantly about building better portfolios. And, I'll make the very bold statement that if you don't have diversity in your portfolio, you're doing a subpar job, full stop. So let's go to the next slide, where you get a chance to see the foundation's report card. The investment committee looks at this at every meeting. It's extremely important. That which you want to achieve must be measured. And the top line, unfortunately, is the naked truth here, which is that there's not much diversity in the asset management industry. It's about 0.9%. People play games on how they calculate these things. Those with the most gamesmanship might have it up to 2% today, but it's a very, very low number. And sadly, if you look at some of the progress that's being made, the fact is there isn't much. And one of the stats, I think this is just one of those fascinating stats, and I'm not sure it's 1,000% robust, but it's close enough, is that at the current rate of change, the asset management industry will be as diverse as the general population in the United States in over 6,000 years. And so that should shock you. And it did shock me a little, but then I thought about it more. I think, no, it doesn't shock me at all, actually, because you watch how badly most people are doing with this subject. But here's the Greater Milwaukee Foundation, very different story. So these are the managers that are currently in the portfolio. We're actually potentially adding one more, but they're not here because they're not added yet. And you can see that 25%, just a little rounding up, is in the hands of diverse managers in the United States. And the definition that the Greater Milwaukee Foundation uses is underneath. 25 is a very solid number, obviously dwarfs 2 and 0.9. Although we don't really care about the 2 and the 0.9, that's insanity. 25 is good. 30 might be better, but it's all based on the talent we find and the opportunity set and the ability to take advantage of variant perception. So we'll jump to the next slide. And here you can see a change. Now I'm going to shift gears on you a little bit, which is to talk about what's happening in the world. This is a really, really interesting time. The first thing is, as we all mature, I guess it's a nice way to say it. It's nice to see some things come back that were part of your career in the beginning. So I've been at Crucial now for 37 years. So I've seen a few things. And one of them was we used to have inflation. And it has significant implications for capital markets and investing in general. So we have higher inflation. Again, let's be clear, we're not talking about the spike up that we saw last year. We're talking more about just steady state inflation being higher than it's been before. And that creates something called a higher cost and competition for capital. So higher cost of capital, what that means is something you guys can, I'm sure everybody can see day to day in your lives, which is you can actually put your money in a money market fund and get a pretty good return today. You can buy a T-bill and get a 5% plus return. That's a higher cost of capital. Wonderful for those of us who are savers or investors, not so good for the people who are the borrowers, though, right? Somebody's paying more for that capital. And the fact that you can and I can so comfortably put money in short-term, very safe, very liquid securities and generate, a decent return means that people who want us to take risk now need to make a better case for it. And that's what we refer to competition for capital. So when you go back, we'll talk about the Federal Reserve in a minute, but when you go back over the last 10 to 15 years, because there's been so little paid to savers, as you guys all know, we've kind of been forced out the risk curve. And now we're not being forced out the risk curve. And that's really important because now people have to compete for your attention, compete for your capital. And that really is important. And that creates what we see in the second bullet point, which is something we call capital scarcity. And we'll talk a little bit more about this in the end, but just to be clear, capital scarcity doesn't mean there isn't capital around to be invested. It means that people don't want to part with it. And the psychology gets into this equation, which is fascinating. And we'll talk about that in a minute. And then last but not least, capitalization weighted indexes like the S&P 500, despite the risks that are out there, have become increasingly risky themselves. So we'll talk about that also in a second. So let's jump ahead to the next slide. And we'll take a look here at essentially what we're referring to as a part of the equation around the cost of capital. So one of the key things to consider is that, yes, interest rates are higher today, which is good, and we're all enjoying that. But unless inflation is about to come back down to the levels that was before COVID, interest rates are really not that high, and which means that they should go higher. Again, there's a lot of assumptions in that. So again, don't take that as a forecast for the short term. It is not. But this graph is really interesting. So it goes back to 1960, and it is showing you something that used to be, basically sacrosanct for investors, which is that you or I would demand that we get paid a yield on a treasury bond that exceeds the rate of inflation at the moment. And that's what this is. So US 10-year yield is the 10-year treasury, less core PCE, that's basically inflation. And you can see here that other than, for example, in the 70s, where there was a real big spike of inflation, of course, as we know, and then more recently, from 2010 or so on, yields have been basically extremely low by historic standards. And now they've been negative for a while. And negative means that when you take the yield on a treasury, you subtract whatever inflation is, you actually get a negative number. So the historical number is that you should get about 2% above inflation. And right now it's still negative. So really interesting to think about that. And so if the 10-year treasury yield is, let's say, 4% today, then inflation really should be 2%. And if it's not going to be 2%, then the yield should be higher. And so you can see this is still a very unusual scenario, and people are justifiably intrigued by the change in rates, but the rates haven't really changed as much as maybe they should, unless inflation is about to come way down. So pick one or the other. Either way, bonds should pay more than inflation. And let's go to the next slide. So we'll talk about why it hasn't been the case for a while. So this is the Federal Reserve's balance sheet. And it's a wonderful thing being a Federal Reserve or any central bank, especially the United States Central Bank, which is that you can literally create money out of nothing. It's a fascinating power. And one that if you look at this graph, so this is showing you the size of the balance sheet. What that refers to is how much money essentially have they sort of created. I'm being a little bit vague about that because it's a little more specific than what I'm going to suggest, but let's just keep it simple. And if you look from 1994 to about 2008, you can see that the balance sheet grew relatively into a relatively minor and relatively steady extent. Then you see that first jump up in 2008, 2009, and that was the beginning of the Federal Reserve's reaction to the great financial crisis and the housing bust we had at that time. They were trying to keep the economy from collapsing, good idea, and also trying to stabilize the housing market and make sure that the average person in this country didn't suffer any more than they already were. And that was a really good idea. The problem is that it became like some kind of drug for them, and they kept adding and adding and adding to the balance sheet. And you can see, if you look to the right side of the graph, there's kind of a bit of a dip. That was the Fed trying to get out of that. And then unfortunately for them, COVID hits. And so that led to the next big gigantic increases you see in the balance sheet. And so that unfortunately is where we're at today. We have this giant balance sheet. Now they're again back to trying to lower it. But the key point here is from 08 to basically 2021, the Federal Reserve was doing something extremely aggressive, extremely unusual, and arguably not sustainable. And so now it feels like, and we refer to in a climate member of this like being like the time of bottomless margaritas. Like now the margaritas are gone, and we have to live in the real world where there's not tons and tons of money being thrown at the system. And this graph explains the prior graph. And if we're going to get back to a world where essentially the Federal Reserve's balance sheet is shrinking, or at least even if it's stable, we're not going to have negative real yields. We shouldn't, at least. The market should operate in a more healthy way. And that's good news for us mostly, but it creates a lot of strain on the system while it's kind of unfolding. So go to the next slide. And here you can see the problem that we're also worried about today and the dichotomy in a minute, which is that the S&P 500, while this is happening, this big giant changes going on in the world. And by the way, I haven't even mentioned geopolitics, the battle going on between the U.S. and China, the multipolar world we live in today. I mean, this is not a simple world. You don't need me to tell you that. And in all that's happening, people want more and more and more of just a few companies, and that's what this index and this graph shows you. So let me just quickly explain what the S&P 500 does in terms of construction. Basically, there are 500 companies in the index, but they're not weighted equally. Each company's weighting in the index is dependent on the size of the company. And the size of a company is the number of shares outstanding times the price. That's the market capitalization, we call that, those two, when you multiply them. So what you're seeing here is the top 5 names, which are in order: Apple, Amazon, Alphabet, Microsoft, and NVIDIA, are now being June 30th, 24.1% of the index. And that's really interesting. One, because you can see, look at the history, whereby you can see that essentially that's way higher than it usually is. And that is extremely interesting. And I would remember what it says at the top: concentration leads to risk. They're closely related. The topics cannot be separated from one another. And the reason that we have this issue today is because of the first word, comfort. People are very comfortable with these businesses, and they are comfortable with these businesses for a good reason. NVIDIA is a little more complicated, but the other 4 are extremely well-established, extremely successful, extremely stable businesses. And it's no one's arguing that they're going to disappear. But when the stock prices get too high, bad things start to happen to you, which is what we're saying at the bottom, which is there's no law that business quality and stock prices are correlated. Let me give you an example. When you look at that graph and look at kind of a third of the way over from the left, you can see that's the spike up around 00. That's the TMT bubble in the late 90s. And that was a different group of companies that led it, with one exception, which is Microsoft. Microsoft was on that list back then too. And what's interesting that happened to Microsoft next is exactly what probably happens to the darlings of today, which is they fade into the gray, let's call it. Microsoft stock from around 2000 to 2018 significantly underperformed the indexes. And actually it took it years just to get back to where it was in 2000. That's the same fate that awaits probably some, if not all, of the top names today. Now, people have a hard time thinking you're out of your mind. You can't possibly write. And we probably shouldn't speak in too many generalities here. But the fact is that when things get too expensive, bad things start happening to you as an investor. And this is fascinating because at the same time that there's so much risk taking going on, even though people feel like it's not, there's a whole world of stocks out there that are extremely attractively priced, which leads us to our next slide. And this is just a fun picture of the absurdity of the world today. So again, market capitalization is the size of a company. And what this graph is showing you is the size of Apple as a company, biggest name in the S&P 500. I think it was more than 8% of the index in June. And this blue line is the Russell 2000 index, which is, but it's 2,000 small, mid-sized companies in the United States. So none of them are Apple. None of them are even as good as Apple, but there are 2,000 of them in this index. And you can see that just as of this year, Apple is now worth more than the entire Russell 2000. And yes, there's some crappy companies in the Russell 2000, but they're not all bad. And the fact is that this is just a great picture of how unbelievably unhinged the markets have become. And we're obviously trying to deal with this problem, which is that we have benchmarks that we need to keep up with. We have returns that we want to achieve for you. And at the same time, we know that the big money is going to be made way away from these big index positions. And that's where the portfolio has a really great balance today. And it's a really important part of our strategy. But we're trying to walk a fine line here because we don't know when. We just know that there will be a change. We don't know when there will be a change. And that's always a challenging problem. So we'll jump ahead to the next slide. And I want to spend just one more minute before we wrap up and get to the questions, talking about capital scarcity again. So this is a world we don't spend a lot of time on these calls, but what I'm showing you here is a little bit of a picture of what's happening in the venture capital community today. And so this is an organization called Crunchbase, which is kind of a big data information provider in the venture world. And they're providing here a graph which shows us essentially looking at companies by year. These are private companies. They're startups, basically. Which companies, how many companies, just by number, were able to raise what we call a post-seed round of funding versus not raising a post-seed round of funding. So real quickly, seed capital is what's provided to relatively young businesses, usually by venture capitalists. The foundation has some of these investments, by the way. And the goal is, to discover the next Amazon, essentially, and you can make a lot of money when you do that. So what happens though is companies don't usually just need the seed money. They need money along the way as they grow and succeed. You may have heard the terms A rounds, B rounds, C rounds. These are the later rounds of financing that companies use to raise money to sustain and grow their businesses, essentially. So it's great when you're a company, you get that seed round of capital, and then you try to basically raise more capital over time. And that's critical to your survival and your success. So now let's talk about this graph. So the blue, again, the dark blue, too many blues here, but the dark blue are the companies that are kind of making it along that journey. They're being able to raise that next round of capital. So they have a post-seed round. That's why you see that there. The lighter blue color is the no post-seed round of businesses. So these are the companies that are not able to raise a round after that, which means that unless they're already generating lots of cash as a business, which can happen, but more likely is they're not going to survive because they can't raise capital, they can't keep their technology in place, they can't keep their people employed. I mean, that's the end of the road. So look at the graph now. 2018, 2019, even into 2020, it was kind of 50-50 proposition. In fact, a lot of companies got post-seed funding, and that was those are the golden eras of capital, plentiful capital. Now, 2021, you start to see a change where all of a sudden it looks like the market's getting more discerning. And in 2022 and 2023, it's almost like nobody's getting any post-seed funding. And that's capital scarcity. That's people saying, oh my gosh, there's a lot of risk here. Oh my gosh, I have other things to put my money. Oh my gosh, I can make 5% a T-bill. Maybe I shouldn't be investing in a startup business that may or may not survive. And the critical point is what I just described, which isn't that there's not money out there, but it's plenty of money. Venture capitalists are sitting on tons and tons of money, but they don't want to part with it. And that's the psychology of capital scarcity. And once it gets itself ingrained, which has begun to happen, stuff happens and it gets more complicated in the world. So we'll go to the next slide because we think about all of these things all the time. And we talk about at the investment committee, how to invest your capital. And the reality is that we have to deal with a world where things change. And at the same time, we have guideposts and things that we rely upon to succeed. And that's the critical part, but we're not blind to what's happening out there because you need to be aware. You can't ignore these things; they're too important. So first thing, we stick with ideas that have long-term outcomes. That's why, by the way, we're still investing in venture capital because the long-term outcomes are still extraordinarily good. What are we doing differently today? Well, we're thinking not really that much because we didn't really buy into the bubble days of a couple of years ago. Anyway, we're trying to avoid that. But what we're doing differently today is making sure that we have managers who understand capital scarcity better and understand how to know when to lean in and provide capital, because great businesses should get capital. They don't always get it, but they should. And you have people who know how to do that. The second point, which we've always done here, is we use scale, stability, and our time horizon to access some pretty unusual investments. We do some things that most people don't think about doing or don't have access to information to do. But those things, and those things have been very successful for us over time. And there's a lot more to come there. We're really excited about some of the stuff going on in the portfolio right now. But importantly, when we can't find anything great, we can use index funds. We are not anti-index funds, although the index, as I mentioned earlier, makes me a little nervous today. And then last but not least, over the long time periods, It's not fun, but the volatility that we've seen in the last few years is usually good for us, and it has been in this case too. Volatility is very unpleasant, but the fact is it creates the inefficiencies in the market that we rely upon to succeed. So thank you so much for your attention. I think we have one more slide, which is a Crucial Partners commercial. I'll just remind you that Crucial is a New York City-based advisor. We work predominantly with endowments and foundations. We do not manage money, so we don't have conflicts of interest. We get up every morning and try to do the best we can to generate strong returns for you and all of our other clients. And again, thank you. And I think we're going to turn it back over for Q&A now.
Thanks, Mike, for that great presentation. I feel like I learned something new every time we talk. So one of the things that came up, and you kind of touched on this, was the bond market. And this has come up with some of our donors and things. Will developments in the bond market cause organizations like ourselves and yourself to rethink investment strategies going forward, or is that still going to be kind of that long-term hope for the best looking that way?
That's a great question. So yes, it has a real significant input. It is a significant input into the way we think long-term. One of the things, just to use the bond market, such a great example because it's relatively straightforward. One of the reasons the bond market has gotten so interesting is interest rates are higher today. And when rates are higher, what that really means is you can say something very, very simple but true, which is that long-term returns are now higher because you're going to get all this extra income. It's really that simple. And so, yes, there's more and more pressure to put money in the bond market, but you have to keep in mind that, especially from the foundation's perspective, bonds are a bit of a tax on our ability to support purchasing power over time. The 4 is not 8. The second thing is, because the foundation has this, really interesting diversified portfolio, there's a lot of competition for that money. And so when the stock market falls, it gets more interesting too. So we're always making a choice between these two things. But the bottom line is the bond market is more interesting today, and it creates a lot more interesting opportunities. So yes, it's very much a long-term, more compelling case than it was a year ago.
Great, thanks for that, Mike. I wanted to talk next on agency endowments. Last quarter, you had kind of given some words of wisdom for agency endowment fund holders. That was essentially hold tight. Things might get a little rocky before they get better. And I was just curious, has that advice changed? Have you seen any changes in the market volatility that would lead to a change in advice?
Yeah. So the advice is very long-term, so it doesn't change, but it's really worth pointing out, though, some of the nuance behind what you're asking about, because it is a really interesting question and a hard one. So part of the advice from last time was, yes, the world is complicated. Yes, it can be very volatile for a while. But, if you're long-term oriented, just be long-term oriented because you never know what's going to happen. And now we find ourselves today, with double-digit gains in the portfolio, through the date of this recording. And I'm always going to put that qualifier in there. And it's interesting when you think about it, because that's sort of a surprise to people. And the second thing, which is even more surprising, is what you said it, because I did say it last time, was wrong about what I said, which is I said it could be rocky, which is, by the way, a total fallback thing, because you never want to tell people it's not going to be rocky. So it's always going to be rocky. But the reality is that it really hasn't been rocky at all. Volatility in the markets have been very low. And so I would tell you this. So the one little change, and it's very subtle, I'll try not to make it too confusing, is, well, let me start. What's not going to change is, if you're long-term, be long-term. Don't worry about what's going to happen in the short term. That's the first point. And the second point is that if you're feeling more comfortable and it makes you want to be extra aggressive more than you normally are, and maybe just beyond the point where you should, don't do that. The volatility will come back in the market without any warning. No one's going to send you a memo before it starts. It's just going to happen. And then you're like, oh gosh, I had the wrong portfolio. So stick to your long-term plan is always good advice. And don't get sucked into this, oh, things seem pretty good right now, because it's never the way it works.
Thanks. Along the line of changes kind of to the portfolio and how we're looking at investments, some of our donors have mentioned noticing an increase in private equity investments in our portfolio. So what is the rationale behind that increase, and what does that mean for the portfolio?
Yeah, it's a great observation. So a part of that is a bit out of our control because the way it works is the vast majority of the portfolio is what we refer to as publicly traded. So, you can look, I don't have my phone, you can look on your phone and see the price of anything. And that's what we use in the returns and the market values that you see in the portfolio. Private investments are different because there's no public market, obviously, because they're private. And so what they're worth is a bit more of an art until they get sold. And so these are more controlled by the managers. There are outsiders looking, advisory boards. It's not like it's completely, run amok, but it's just not as responsive to what's happening in the short term as the public markets would be. So what happens is a time like last year, when the public markets are coming down, the private stuff just didn't come down as much. And what that did is it led to its growth and its increase in its size inside of this overall pie. In 2023, we're actually watching the private portfolio, first of all, do a little bit of a mild correction itself, and the public markets are coming back. So the weights are starting to drop again. So these are very expected differences that we see over time. And we really don't let them phase us too much, except that we are very focused, as you would hope, on making sure that the foundation's managers in the private space are acting responsibly and are not pretending something's worth more than it is or less than it is. And frankly, so far, so good on that front. We're quite pleased. So that'll kind of fix itself over time is the answer to your question. And it's not a strategy, and I should also add. We have the weight we want.
Appreciate that. We still continue to get a fair amount of questions around ESG investing. I know you spoke to that a little bit last meeting, but I was wondering if you could speak more broadly to what you're seeing across the foundation community and as a whole with some of your other clients as well and how they're approaching ESG investments.
Yeah, it's a complicated topic, and it's also become a political topic too now. So it's even more complicated than it used to be. And the reality is that some of what's happening in the ESG world is window dressing and meaningless. And so if you've read articles and have heard this is a bunch of stuff just to raise fees for investment management firms, some of that's actually correct. It is. With that said, what people are doing, and the Great Milwaukee Foundation has done this as well, is thinking deeply about risks, because ESG, put aside the screening, put aside the articles you read, ESG is something that we were actually taught decades ago, which is it's a risk framework. If you're killing your customers, for example, that creates a risk to your business. Those customers can't keep buying your product, just to use a very simplistic example. And so it's always been part of the risk framework. And that's really important to keep in mind. So ESG, put aside everything you've heard, is a fundamental part of actually any good investing. And it's not necessarily a values judgment. It can be, but doesn't have to be. And it's so the foundation and others and our other clients too are increasingly thinking about, first of all, the impact of their investments, and ESG and impact. I know people don't like to hear this, but they're not the same thing. They can have impact, ESG decisions, but they don't have to. And impact is something that is sometimes very local. Sometimes it's more broadly based or global. And it's really interesting to think about it. And so we're developing actually new tools, and the foundation has not had this unleashed on it yet, but soon will, that reflects some of the work that we've done at the company level to measure not just impact, but from our world, some of the ESG factors that people do discuss regularly. So it's an old and a new issue, I guess, at the same time. And I would say that I think we're all trying to find ways to be very responsible and very pragmatic and very fact-driven.
Thanks. With that in mind, you kind of picked right up on the next question I had, which was kind of about that mission and impact investing. So we also kind of briefly touched on this last time, but opportunities for impact investing keep emerging more frequently when community foundations and community foundation sector. And we know that we've talked about our hyper localized investment opportunities, particularly with our small business loans and equity investments within our own impact investing portfolio. So how do these types of investments impact the foundation's overall financial performance when it is maybe more hyper localized, or what it does look like on a broader scale?
Yeah, no, it's a great question. It's really interesting. I'm always worried about something that sounds too good to be true, but I think a lot of impact investing really is a little bit in that category, or very much in that category. And by the way, I've seen the kind of localized impact investing the foundation's doing being done now. I've seen it's been being done for 21 years at a client so far. And it fits into our overall strategy quite well. You saw on the slides, we had a 5% allocation to mission investments. And that's part of the strategy. It's when we measure the expected returns of the portfolio and the actual returns of the portfolio, we include that in there based on the return profile and the risk profile that we've assigned to the foundation's investments to date. And it's part of a diversified strategy. So it doesn't actually create any negative impact because it's not being, by the way, we're not taking high return venture capital and putting it into lending. We're taking it from a lending part of the portfolio where the return differential is almost non-existent. And then you said something really interesting, Kelly, which I think is really worth spending just a second on, which is the idea of it being localized. So is that a bad thing? And the answer is, well, I guess it could be if you made bad decisions, but so far I can see the foundation is not making bad decisions. But it can be a really good thing because your knowledge as the lender is that much better. I mean, you're not lending to somebody that you don't even know. You're lending in your community. You're lending to people and businesses that are well-known, well-vetted entities that you can, are going to pay back, which is why what we've seen in other community foundation portfolios, and I'm starting to see here too, is that this is very low risk investing because it's so well done in the sense of knowledge. And so it's a really important part of the strategy and one that, frankly, is not at all, it's only good is the way I would describe it.
Thanks, Mike. I'm going to take us in a slightly different category with this next question. I was wondering if you could speak to how you and our investment committee actually work with our trustee banks for the foundation. And also if you could just speak to, how our investments and our strategy is really influencing other, major players in the financial industry and in Milwaukee specifically.
Yeah, so with the trustee banks, it's a really wonderful relationship here. I've worked for a lot of community, and Crucial's worked for a lot of community foundations that did not have this setup. So I'm about to describe is extremely unusual, which is just a real partnership here. And what that looks like is, first of all, the trustees, banks individually come in and make a presentation to the investment committee once a year. They obviously see performance every month from the trustees. We generate that too. So we have once a year where we interact, get to hear what they're thinking, their strategies, ask questions and have a real engaged dialogue and relationship. Offline, the trustees also interact with the foundation's management team and with Crucial and me when they want to do things in the portfolios, not because we're not in charge, they're in charge, but they really, in the spirit of partnership, come to us and say, hey, this is something we're gonna do. Do you have any questions? Do you have any comments? Do you have any concerns? We'd like to hear what you think. And they mean it. And I think that's extremely, extremely great. And frankly, in terms of just the broader financial community, I think just the collaboration and the knowledge that we're all actually totally trying to drive for the same outcomes here, which is, philanthropic impact in the greater Milwaukee area, is just hopefully a model for other people to think about in terms of how to do this right. And your trustee banks are fantastic partners to the Greater Milwaukee Foundation.
Well, thank you, Mike, again, as always, for answering our pressing questions about our investments, but also, doing the good work of keeping us in line.
Yeah, really appreciate it.
Welcome. It's my pleasure. Always a pleasure to be with you guys. Thank you.
Well, thanks, Mike. That was a wonderful presentation and conversation as always. Really appreciate you taking the time to share your expertise, knowledge, and advice. I just want to take a moment here to speak to all of our current fund holders and just want to really promote our new donor portal that many of you have had the opportunity to sign up for. For those of you who have not, I would really encourage you checking your email for a link. And if you can't find it, make sure you reach out to your philanthropic advisor. The new donor portal is a great opportunity to get your current fund statements, access to your donation and grant history, as well as make new grants. And we're just really excited to roll it out to all of our partners.
We also encourage you to reach out to the foundation and your philanthropic advisor with any questions you might have or ideas for the next investor briefing, which we hope will be a live virtual event in mid-November. So please keep an eye out for that. And as always, please contact your philanthropic advisors for help with grants, contributions, learning more about that donor portal, and especially our Greater Together campaign that is wrapping up by the end of this year. So thank you again, everyone, for watching, and we'll see you next time.
Take care.